Thanks for joining us today to hear about my highlights of the article I authored for the National Cattlemen's Magazine July edition titled, Will High Fuel Prices Impact Beef Demand? Joining me today is Fallon Savage, Senior Vice President of Corporate Credit at Farm Credit Services of America. The article highlights what we see in terms of prices going up for fuel prices, which have increased about $1 a gallon due to the Iran conflict. We've seen continued strong beef demand since the beginning of the year. Beef demand's up about 8% year over year. Spending so far this year's up about 10% from a real per capita expenditure standpoint. We continue to see solid restaurant traffic, but here of restaurant operators starting to notice that their traffic has slowed just a little bit. And on top of that, we continue to see continued wage growth and strong growth in the U.S. jobs market. We added about 565,000 additional jobs from January through May. This was a large increase in revisions compared to the initial market data that came out. So we continue to see that as an opportunity for beef to grow in terms of market share. In fact, so far over the last 12 months, it's accounted for about 80% of the growth in retail grocery spending growth from the last 12 months. So strong performance there. With that, I'll ask Fallon, what do you think about what's going on in the market here and how these might impact cattle producers?
I have to say, Dave, I was really surprised when I first got your article. When we first saw, gas prices starting to tick up, that was the first thing we started discussing in the office was, oh no, what is this going to do to beef demand? And so it was really reassuring to see kind of your general points talking about that while prices have ticked up on a gas perspective, overall demand has not necessarily diminished of any great degree. So as we continue to talk to customers, one of the main things that we continue to focus on is what is our risk management strategy? As we're taking a look at replacements coming in the yard, what does that look like on a per crop basis? What kind of liquidity do we have sitting around to be able to put into these animals? And so a lot of our conversation is around, what are you able to protect right now? And what is this going to look like going forward if we start to see some of that demand drop off?
Absolutely. And those are great points. As we look at the opportunity we've got for producers, especially feed yards looking to replace cattle, those record prices are going to generate some likely record break evens coming out of the feed yard. So that risk management program important, but maybe having some flexibility in that and leaving some room, maybe through an option strategy or something like that with some upside opportunities, probably a good thing for them to look at.
No, absolutely. I think one of the things that we're continuing to talk to them about is what can you afford to lose? And if the answer is not a lot, then that really starts to drive what your risk management strategy is going to look like. I think right now, as we continue to talk to producers, one of the things that we've been pleasantly surprised at is a lot of the yards keeping a lot of their earnings within that operation. They're needing to have those higher levels of equity going in on a per animal or per head basis. And so as we continue to look out into the future and kind of monitor and say, okay, what are margins looking like? We continue to ask, and I'm going to ask you, so if fuel prices aren't going to break this, what's going to ultimately end up breaking the consumer? What's going to say to them, yep, I can no longer afford this price point. So what do you think that eventually the consumer is going to start to back away and say, I can't do this anymore?
It would have to be really truly a black swan kind of event. You look at the consumer side, early on we were concerned about GLP-1s and the reduction in calorie consumption and maybe that it would impact meat consumption. It's kind of turned the opposite in terms of that percent of their diet. They're really looking because they're going to eat less, very nutrient dense products.
High quality products.
Yeah. High quality, good to eat. Part of that is your palate and your satiation is downregulated, so you just don't want to eat as much. So whatever you're going to eat, you're going to want to be pretty good to kind of get you enticed to eat it. So that plays right into beef's territory here. The opportunity, I think, for folks here, I think if something keeps me up, it's the amount of risk the average producer walks around either not recognizing or not doing anything about. And I like to coach folks that, even if you do nothing, it's doing something when it comes to risk management. And at least at least be cognizant of what that is and what it means to your operation, and find a way to protect the revenue you got to have to live another day. One of these bad things happens. So as an opportunity, and maybe to kind of close our discussion here, yeah, we're looking at what we think is still bullish picture for beef demand. Consumers still getting more wages, more jobs. We continue to see record stock market prices, maybe a more stable inflation and interest rate environment coming. We're hoping. So all things today point to caution and be watchful, and we'll continue to watch those things as we go forward here.
Awesome. It was great to connect, and
Yep.
great to chat with you, Dave.
Thank you, Fallon.